Citigroup, the parent company of Citibank, has faced numerous challenges since the 2008 financial crisis. Its stock price has continuously struggled over the past decade, reflecting broader issues within the company. Once the largest bank in America, Citibank now ranks third in the US and 11th globally in terms of assets. This video will explore the reasons behind Citibank's decline, its current position, the strategic changes implemented by CEO Jane Fraser, and the future outlook. Citigroup was hit hard during the 2008 recession, requiring a $476 billion bailout from the US government. The company struggled after the crisis, and its stock price collapsed from over $500 per share in 2006 to under $1 in 2009. According to macro trends, its stock has faced ongoing challenges over the past 5 years. Between 2019 to 2023, the stock price declined by 18.93%. This continuous struggle reflects the bank's profitability issues. As the CNBC reports, Citibank was once the largest bank in America, with over $2 trillion in assets in 2007. However, it is now the third largest US bank behind JP Morgan Chase and Bank of America. Globally, Citibank ranks 11th in size with $2.4 trillion in total assets. The company has lost significant ground. As per Retail Banker International, Citibank now ranks 7th among US banks in terms of capitalization and customer base. A Moody's downgrade in 2023 placed further pressure and contributed to its declining position. As Reuters reports, Citigroup's stock dropped along with other major US banks after the Moody's downgrade. While the largest banks remain profitable, it is more vulnerable in the current environment. This downward trajectory raises a critical question. Why are Citibank branches closing around the world? According to Financial Times, Citigroup's CEO Jane Fraser has acknowledged the company's issues, including worst-in-class efficiency, returns, and stock valuation. On an earnings call covered by Yahoo Finance, Fraser stated that Citigroup had been clearly disappointing and noted the urgent need for change. The company reported a $1.8 billion loss in 2022, driven by reorganization expenses and other charges. Forbes Advisor reports these struggles have persisted over the past decade. Citigroup's returns and efficiency lag peers like JP Morgan and Bank of America. Its price-to-tangible book value ratio of 0.5x is well below the 1x level considered acceptable. Ongoing challenges have prevented it from fully recovering. As Britannica outlines, Citibank has been a global financial institution since the early 1900s. Its origins trace back to Citibank of New York, founded in 1812. In 1915, it greatly expanded overseas by acquiring International Banking Corporation, which had 21 foreign offices. By the 1970s, after numerous mergers and acquisitions, the company was renamed Citibank. It continued expanding globally, operating in over 90 countries by the 1980s. In 1998, it merged with Travelers Group to form today's Citigroup. At its peak, it was the largest bank in America. While once the biggest US bank, Citigroup now ranks third domestically and 11th globally. Macro Trends data shows Citigroup's total assets have declined 0.36% year-over-year as of December 2023, reflecting its shrinking global footprint. As Yahoo Finance reports, geopolitical tensions, currency devaluations, and instability in key markets like Argentina and Russia contributed to Citigroup's global decline. The bank faces challenges in reversing this downward trajectory. As Citigroup official highlights, Jane Fraser became CEO in March 2021. She previously held various senior roles in the company, including head of the Global Consumer Bank. In April 2021, Fraser announced a major strategic shift for Citigroup. She decided to exit 13 consumer banking markets outside the US as part of a plan to simplify operations and focus more on wealth management. In line with Forbes, bold leadership decisions will be integral to shaping Citibank's future direction. Fraser is positioned to drive necessary changes as CEO, but successful execution remains critical. As announced by Citigroup official, the company aims to wind down consumer banking in markets spanning Asia, Europe, the Middle East, and Mexico. These exits will unwind a long-running global retail banking experiment. CNBC explains Citigroup pursued an aspirational global vision, but the model of seamless worldwide consumer banking services has yet to materialize. Hence, under Fraser, the company is reverting to a more localized approach. While reducing Citigroup's footprint, the market exits also aim to free up capital for strategic reinvestment in more profitable areas. However, as UKSA's notes, the impact on revenue generation remains uncertain. As stated by Brand Finance, Citigroup previously strived to build a global banking brand through consumer banking in 160+ countries. However, Fraser is now unwinding those worldwide ambitions to focus more on institutional and wealth management clients. This shift acknowledges that the universal global consumer banking vision pursued by past CEOs failed. Citigroup is therefore adopting a more localized approach that aligns with modern realities. Citigroup official announced the completed sales of consumer banking businesses in 8 markets over 2021 to 2022. As the company stated, these sales have advanced the wind down of less profitable overseas retail operations. As highlighted by the Financial Times, it is simplifying into a less complex and more coherent business. While challenging, analysts praise Fraser for finally addressing built-up issues from mergers and overseas expansion under past leadership regimes. The sales are a key part of its strategic refresh focused on improving returns. However, as Forbes notes, fully realizing efficiency gains from this reorganization will take years. Citigroup plans to divert resources towards wealth management as a central part of its new strategy. The shift aims to improve the bank's weak returns. Wealth management offers benefits like stable revenue streams, growth opportunities in emerging markets, and lower regulatory risk. As Retail Banker International notes, other major banks like Morgan Stanley have also embraced this shift toward wealth management. However, analysts remain skeptical about whether the strategic bet will pay off for this company, given past stumbles in rebuilding wealth management capabilities. The advantages of the wealth management model in greater detail. It generates commission-based revenue streams from investment advice provided to affluent clients. There is also potential for additional fees from services like loans and mortgages. By Forbes' estimation, successful wealth managers earn 1 to 2% annually in fees based on assets under management. The relatively steady income stream is a key benefit attracting banks like Citigroup. Another upside is the growth possibilities from rising wealth in emerging markets like China and the Middle East. According to Insider Intelligence, Citigroup's wealth management revenue declined 5% year-over-year in 2023, falling short of targeted double-digit growth. Reuters highlights that it lags significantly behind competitors in this business. For example, Bank of America's Merrill Wealth Management generated over $18 billion in revenue last year, more than double Citigroup's wealth revenue. The verdict is that it still faces an uphill climb in growing its wealth management business profitably. Established rivals dominate the lucrative sector. Payments Journal notes Citigroup has recruited Andy Sieg, a former Bank of America wealth management executive, to lead a revamp of the business. The bank aims to leverage his expertise and connections. However, as Reuters reports, analysts point out structural challenges. It divested its Smith Barney wealth management business years ago, so it must rebuild capabilities from scratch. While wealth management offers potential, Citi Global Wealth highlights execution risks. Significant spending may be required to gain ground, with uncertain payoffs given the competitive landscape. Success will depend on strategic follow-through. In recent years, Citigroup has initiated major strategic shifts to unwind unprofitable global operations, exit consumer banking markets, and attempt to pivot toward wealth management in response to extended competitive struggles. This transformation aims to put the company on a more stable footing by focusing on its areas of strength. However, formidable execution challenges remain due to its late start in fast-growing business lines like wealth management compared to entrenched rivals. While the strategic direction shows self-awareness of its issues, it will require flawless execution under CEO Jane Fraser to restore Citigroup's competitiveness and stature after years of underperformance. The path to redemption will be difficult, But the company appears committed to proactively adapting its strategy to match the new realities of a dynamic global banking industry plagued by the lingering effects of the financial crisis.